Okay, we are live. Rob,
Let me I can stop swearing now. Welcome.
excellent. All right, so Rob,
Oh,
you know,
okay.
today I talked to a friend I haven't spoken with for a little bit. He's, doing some real estate here in California. He's focusing in on some high dollar properties, like over 1 million is primarily where he's focusing. And he was complaining a little bit today about the recent changes that resulted from that National Association of Realtors lawsuit that affects uh, buyers agents and listings agents. So, I thought we could expand on that a little bit today.
Okay. Okay. I don't do a good Mackie. Sorry.
That's okay.
All right. So what was his take on it?
Well, he was
Him.
complaining that it was uh, affecting the ability for him to represent a buyer that, somebody that's looking to purchase a house, obviously, and who pays the commissions. Because before this lawsuit, it used to be that the listing agent who would go and talk to a home seller and negotiate, let's just say an example of a 6% listing. Not everybody did agree to a 6% listing, but we'll just use that.
Average.
We'll
It was
just
a
use,
national average. It was a
right,
national average. So it's based on
right,
location. So if you're in an area where houses are 30, 40,000, you might be paying a 10% agent commission. If
right.
you're in
It
an
could have been,
area
right,
where it's 20 million, you may only be charging 1 or 2%, or
right,
maybe three. So it
right.
depends. Yeah, but an average
So,
is a
yeah,
good number to use. That was the national average for many years. So let's stick with that because it's easy and it's divisible.
exactly. Yeah. So, he was mentioning that on some of the buyers, they haven't, it just makes it a little more challenging in the fact that who's going to pay the closing costs. Whereas now it's not pre-negotiated with the listing agent when he goes and talks to the seller to get the seller motivated to sell the house. And yeah, so there's a little bit of a learning curve that we
So
should probably.
let's give a snapshot of what it used to be, what the lawsuit was, and then what it is now. So it used to be the listing agent would talk to the buyer or the seller, excuse me, and they would negotiate a commission. And in that commission, they would negotiate a total commission that the seller would pay out. And then they would, so let's say it's 6%.
Okay.
And they would negotiate, the most you're going to pay out is 6%. And if, so sometimes it was structured this way. Uh, the listing agent would take 3% and offer 3% to the buyer's agent.
Okay.
And if the listing agent ended up representing both ends, double ending it, they would take the full 6%. Or if the brokerage house represented both ends, they would take the full 6%. So, in other words, you know, Ricardo, you're the listing agent. I'm the buyer's agent. I bring a buyer into your listing. You're going to pay my part of the brokerage 6%, and you're going to take 6%. And then we get our splits from the brokerage company, whoever the broker is, right? Because
Right.
ultimately, the agreement is signed between the broker, even though you're the real estate agent, you're representing the broker. The agreement is signed with the broker. So that whole 6% technically would go to the broker in this type of a situation. And then you would get your split, and the other agent would get their split from
Right. Right.
And then if you were lucky enough to where you were working with both the buyer and the seller, then you would get your split on both sides.
Got it.
Occasionally it was sometimes negotiated where, if I do end up handling both sides, I'll reduce it from 6 to 5 or whatever was negotiated with the seller.
Right.
But it was really just an agreement on how much the seller was going to pay to the broker
Right.
who that agent represented. So then some of the problems that could arise from that was the agent could say, well, I'm taking 4% and I'm only going to only offer out 2% to anybody coming. So that created some conflicts and arguments in the industry. But that's not what the lawsuit was over. The lawsuit was over basically the fact that the buyer was taken out of the negotiation
Right.
to negotiate their own costs. So all these
True.
costs were pre-negotiated in, and the buyer could not negotiate. It could be argued that the buyer's agent was also knocked out of the negotiation process. That's not part of the lawsuit, but technically the buyer's agent was also locked out of the negotiation for their compensation. And
Right.
that could cause some problems because there was a little bit of steering that could possibly go on. Even though the agents have a fiduciary responsibility to do this and that, if you have one listing out at paying 3% and another one listing out that it's only going to pay 1%, they should show you both properties, but they're going to be a lot more eager for you to buy the one that pays them 3. And a lot of times
True.
the buyer did not know, were never told what that was when they were making the offer.
Right.
So because it was listed in NMLS in an area that was not published, so it was basically in an unpublished area of the listing that only agents could see. And if the agent didn't disclose that to the buyer's agent didn't disclose what they were making to their client, the buyer, then it didn't give the buyer an opportunity to negotiate. So that's what the lawsuit was over.
Right.
So it's caused a lot of concern within the real estate area, realtor area. But I think it's kind of like what went on in the lending business back in 2008, 2009. I don't remember when it was finalized, but after the crash, it might have been 2010, everything changed. And originally then, you could make money at both ends. So you could make money from the lender and you could charge an upfront fee to the borrower. And the borrower just really didn't understand what you were making in yield spread premium, YSP. They only saw the origination. So maybe you charge the borrower 1 point or 2 points, and then there was a credit for the rate, which now is visible to the clients usually. So there's a credit, and maybe, when you first started talking to the borrower, and this is one of the things that was bad back then, is that many people would quote a rate originally, let's say par. And if pricing got better and the rebate increased, the LO felt, or the company felt, that was their money to keep and not be passed on to the borrower. So they were charging 2 points up front or 3 points up front, and they originally listed the pricing at par. So let's say it was 5% at par, which means the rate doesn't cost any money, right? Well, pricing got better, and the LO would get maybe a half a point extra or a full point extra because pricing improved, right? They wouldn't disclose that to the borrower. They would lock the rate, and then they would, instead of making 2 or 3 points on the front end, they'd make 2 or 3 points on the front end and a half or a point and a half on the back end, and that would all go in to the broker or the lender, and then they chop it up depending on their commission splits, or how their commission plan was.
Right.
But and people say, well, yeah, that's good. That's fair. If you're a salesperson, you think that's fair. But you know what never happened? If the rate got worse and the rate cost a half a point now because you didn't lock the rate and pricing got worse, and now there was a point or a half a point to buy the rate you originally. So if you originally quoted, 5 points, and it was zero, the cost of it was zero, and now it was costing you a half a point or a full point. The borrower, the LO never went back to the borrower and said, that's coming out of my commission, right? What did they do? They raised the rate back up to the new par, and they said, oh, pricing got worse. So in essence, that really wasn't fair to the consumer, because the consumer was only getting the bad side of the deal. If pricing improved, the consumer didn't get the advantage of that, or sometimes the LO would give them a portion of it to kind of make them feel good that they got a better rate, but they keep the majority of it. So same kind of thing going on, not as devious as that in the sense of with the real estate side. But if the buyer doesn't know what their guy is getting paid, they don't know how much the cost of the house is being affected by that, right? So if they are not disclosed up front when they're making the offer that there are 5 or 6%, we started with 6, so let's just stick with it. If they didn't know when they made the offer on the house that there were 6% commissions that are negotiable by law, they weren't notified, then the consumer on the buyer's side was hurt, and that's where the lawsuit came in.
Yeah, I mean, my first reaction was, here's some more oversight. But then, when you break it down and you look into, what the settlement resulted in, is allowing that buyer's side a little more ability to negotiate their fee and the buyer's agent to negotiate their fee, whereas it was locked.
I think also with the frustration on your friend, the problem is more so in that it's really not settled yet. This is new, this is from a settlement from a court case. And like everything in every business, it will take time for it to pan out on, it's just like when our comp plans, when they changed all the how you can either now, before you can make money on both ends, now it's either the lender pays it all or the borrower pays it all, right? This
Right.
kind of went on in the financial services business too, where people were doing, selling different products based off of the commission they were making, right? Like, an annuity or even stocks, bonds, all that, mutual funds, they were paid a commission from the mutual fund, but they were also charging the borrower money, and they weren't disclosing their commissions on the fund, on the selling that one fund. So that whole industry went through it, mortgage industry went through it, and now it's happening to the real estate industry. It's being cleaned up a little bit. So
Right.
yeah, we're definitely overregulated, but I mean, like everything, 10 or 20% of the regulation is good, and the rest of it is people justifying their existence, if you ask me. And that number may be higher or lower, depending on how I feel the day we talk about this. But you understand.
True.
So,
True.
so now the way it works is, and to be honest, I'm not pulling up the latest and greatest because this is changing. So what's going to happen over the next couple of years is there's going to be lawsuits again because somebody doesn't understand something or something You know, somebody made a
Right.
mistake or somebody they understood it one way and went one way, and then somebody said no. And it's not even lawsuits. It's also going to be self-policed by NAR and the local
NARB meaning National Association of Realtors,
right. And then
and probably California Association of Realtors.
I'm set up with OCAR, which is the Orange County Association of Realtors. So each one of those levels in the real estate game that you pretty much, I mean, you don't
Sure.
have to belong to them, but you know, professionals generally belong to their professional organizations. They're going to end up policing it based on things they hear, because there's also a complaint system within those organizations where if you think somebody else did something wrong with you, you can file a complaint against their NAR registration number, and you know all that. So then there's an internal battle between realtors going on too on what you can get away with. So I think over time that's going to spill out and finally it'll take a couple of years, because things have changed rapidly. You know, like when this thing first happened, they had all these trainings and people were paying money to go to these trainings, and I was kind of sitting back because you know it's not my primary focus. And I was just reading a lot of the articles and stuff, and then I was talking to people. They're like, I've gone to 4 trainings on this, and every single time it's different. I'm going to stop going for a while and not worry about it. You know what I mean? Because they were just
Yeah, slippery slope until it gets,
it was,
you know,
and there was so
yeah.
much misinformation out there. That's why I'm cautious on talking about it. So take this is not legal advice, all the disclosures that come with that. It's not real estate advice, and it's not what
Right.
commissions are, all that kind of stuff. But my understanding now currently is that each individual agent negotiates their own comp plan. So for their broker.
Right.
Are
And I think it also just opens the door for the buyer to know that they have a little more negotiation power than
correct.
what was previously, even though they still had it back then, but now it's being, you know, the doors open a lot farther than it was.
And when they're making an offer, they're understanding what these numbers are.
Right.
Hold on. All of a sudden, I think I'm going to be messed up. My phone is ringing. I'm going to hit ignore.
I got you. You're still there.
Hey, I'm going to have to call you back. All right.
Not us. Not us.
That was not send it to voicemail. That was answer it. Sorry about that. It's okay. It was only my brother. He's probably asking me if I'm going to go to this thing on Friday.
What, the National Association of Realtors or the California Association of Realtors?
It's my nerd stuff, coins. We're going to go to.
Oh, gotcha.
I'm going to a coin show this week in Long Beach, so.
Got it.
He's probably trying to find out if he's gonna tell me if he's gonna go. Okay, back on track. So now, now the buyer gets to kind of control some of their closing costs.
Right.
I won't get into the positives and the negatives of this right now. I'm just going to go through and explain how it works. So the listing agent, he talks to the seller and he agrees on how much the seller will pay him to represent him in the transaction, or his broker, his real estate company.
Right.
So let's say they settle on 3%. We'll just stick with that, a 3% number.
Okay.
And then the buyer's agent will then negotiate with the buyer, his buyer, prior to showing him any houses. So this is one thing that came out, which initially wasn't a part of it, but it's been kind of changed. This is the latest and greatest on this part of it, which is you cannot even show people houses or give them listing information or work with them until they sign an agreement with you. If you do, you're in violation. I don't know what the ramifications are from it, but it's basically means you're probably not going to get paid. There's probably
Right.
interest to the consumer. Like if you show them a house and you weren't under contract, you're not getting paid, but you're still obligated as a fiduciary to represent them. So,
It's good for both parties. It's good for the buyer and it's good for the buyer's agent, right? Because now there's clarity and there's no he said, she said stuff. It's all in writing, right?
it's just like with us, we have to disclose within 3 days all our fees. Generally, I disclose right up in my initial call when I'm talking to them. I say, hey, listen, this is how I get paid. And you can either pay it or we can structure it with the lender paying you. And while they have the ability to negotiate, to be quite honest, I don't really negotiate because I've already got my pricing structured at the low end of the market. So there is no room for me to really negotiate anymore.
Right.
But that's neither here nor there. So back on track. So so the buyer's agent negotiates with the buyer, and let's say they agree to 3%. Now the buyer is saying, I will pay you 3% out of pocket if
Right.
I'm responsible for 3%. So the problem herein lies, and this is where a lot of the frustration is happening right now is, and I understand it from both angles, the buyer has the money. So your friend who's going after these high-end homes, which I won't get into him only doing high-end homes, that's a whole nother issue.
Right. That's irrelevant.
Right. He shouldn't be frustrated by that, because generally people that are in that price range should have the cash. Most of those people buying homes $1 million and above now are making some serious cash. All right, they're making 250 plus thousand a year. Average, but it's probably more than that, right? So most of the people like I'm working with above $1 million that are buying 1.5, 2 million, 3 million, they're making anywhere from $300,000 to $800,000 a year or more. And they should have reserves for that. So they should have money put aside. Now they may not want to use it, right?
Right.
Where this kind of hurts is for the average buyer. Average buyer generally comes in and they have just enough to put their down payment in and cover, $10,000 or $20,000 worth of closing costs. Now you take a $500,000 property and you throw 3% commission on top of that, it starts to hurt, right?
Right.
So that's where they're getting frustrated, because they're going around, they've signed an agreement with this buyer who doesn't have the money to pay them, and they don't know how they're going to get paid. And the only way they can get paid is if they then go and negotiate a contingent upon the seller picking up their commission.
Right.
And I don't know if that's one of the dilemmas in this, is that now you've negotiated with the traditional thing was the seller always paid it, and they prearranged how much the max they were going to pay. Now the seller has lost control of that negotiation, in the sense of the buyer has negotiated, and then you have somebody who has no cash negotiating a deal that they have no intention of paying. So they're not being frugal in it, because they're saying, well, yeah, sure, I'll pay you 3% at closing, as long as we can get the seller to agree to it. So now
Right.
it's going to open up a secondary round of negotiation, maybe, or it's going to negatively affect the market, because really this is not changing for the most part anything going on with the purchase price, because you figure, okay, if the seller is only planning on paying a 3% commission and they're not going to cover the buyer's agent, then the house is overpriced if it's done under the old model, right? Where they were used to paying a 6% interest rate. I mean,
Right.
6% commission. They factored that into their listing price. And when they sold the house, they factored that into their total total
Right.
return on the property when they sold it. If they were smart, when they were looking at an offer, they said, well, okay, they're offering me this, that's below what I listed it for. Am I okay with all these costs that I'm incurring, all the closing costs, the 6% commission, paying off my loan? Am I getting the ROI expected still? And then they would
Right.
negotiate based on that, right? Well, now the seller is just negotiating the original listing price generally based off of their commission that they're paying to just their listing agent. And they've washed out. Now, some of them think, oh, well, that means I'm going to make an extra 3% on this property when I sell it, right? No,
Right.
if I'm a buyer and I'm paying my agent the commission out of my pocket, I can guarantee you my offer is going to be 3% lower
Right.
than if you're paying
Right.
my guy, right?
Absolutely.
But a
Absolutely.
lot of people seem to think that, the seller is going to, pocket 3% more. A lot of
No.
sellers think that. But there's just going to be an adjustment to how the market is. And then that's going to get you a lot of weird comps in neighborhoods, because one house was sold 3% lower because the buyer paid the commission, and another house is going to be 3% higher because the seller paid
The seller agreed to roll it into the purchase
they
price.
factored
Got it.
into their purchase price. So let's say,
Right.
I listed my house for 500,000 based off paying only 3%. And the
Right.
buyer comes in and he says, well, I'll make an offer for 500,000, but I want you to pay my buyer's agent commission, which is 3%. Well, if I'm the seller, I'm going to counter and say, sure, I'll pay your agent's commission, but I'm going to increase my sale price by 3%.
Right.
Follow me?
Yep.
And that's what's going to happen in the negotiation. Or maybe the seller will come back and say, well, no, I'm not going to pay the whole 3%. I'll only pay, 2.5 or 2. And then the buyer can pay the rest.
Right.
So that's where it gets into a negotiation, and that's where the sellers will be asking for, and I'm already kind of seeing it in some listings, where they're asking proof of funds.
Yeah, of course. Proof of funds is big.
So
I mean,
they're like, I'm not even
if you're a buyer,
right. If you make me an offer on this house, I'm going to want to see, and I'm not paying the closing agent, your buyer's agent commission. I want to see a bank account that shows that you have enough to cover all the closing costs, plus your down payment, plus
right?
your agent commissions, because I don't want to get in this thing and we get to closing and it's all locked up because you
Exactly.
can't pay a closing.
Exactly. Exactly.
Right? If I'm
It's a disservice. It's a disservice.
a listing agent representing the seller, I'm gonna want to make sure this buyer has all the cash that's going to needed to close. It's the same thing. I know this one realtor that always talks about, a cash deal is a cash deal. Quit telling me it's a cash deal and then running off trying to get a loan at the last minute and then dragging the loan out.
Right.
And when you say, you prove to me that you have cash, and that means all in a U.S. bank.
Right.
Is cash. I don't want to hear about stocks and bonds that you're going to possibly sell, because we know that
Right.
makes forever to happen, you know, all that kind of stuff.
Right. Right.
And that's the way the listing agents and the representing the seller is going to be doing this now. Is they're going to say, "Hey, show us all your proof. Don't
Right.
send this. Don't even submit it." Now, if you're asking for us to cover it, that's fine. We may cover part of it, and you can keep some of your cash available. But if I would be like, no, I need to see, you know, all the cash to cover all your responsibilities,
Yeah. Yeah.
because that then gives the seller the ammo to negotiate.
Right.
You know, because they may have one buyer that has $500,000 in cash sitting that can cover everything, regardless of how we negotiate the closing costs of the buyer's agent, right?
Right.
But I might have another one that has enough to cover closing costs and down payment with no reserves, no nothing. Which would you choose? Then it gets down to let's negotiate, right? You want me to cover the closing costs? Well, maybe I'm not willing to cover all of them. Maybe I'll only cover, you know, a portion of it, and you can pay the other portion. But if you've got somebody who doesn't have any money to cover the buyer's agent, now your only negotiation is to cover that. Now, that then puts you in that gives you the leverage to ask for more than for your house, right? So,
Yeah.
So, let's make the assumption that sorry. All right. Sorry, I'm doing some math in my head. So on a $500,000 home, 3% would be $15,000 you're paying towards the buyer's agent, right?
Yeah. You'd net 485,000.
Well, no, I'm not talking about that. I'm talking about the offer is 500,000, and you pay my agent, right?
Oh, I see. The buyer's offer. Got it.
Right. You may counter and come back and say, well, if you want me to pay your agent, we're going to be 515.
Right.
Right.
Or whatever the 3% equivalent is. Yeah.
Right. That's 3%. Or you may come back and say, well, I'll cover. If you're me, I would be thinking, if it's somebody who's not showing me they have the cash to cover it, right? And they want my house and they can't pay their own agent's fee, as a seller and a listing agent, I would come back and say, we will pay I would counter with $525,000 you buy it for, and we'll pay your 3%. I have just now increased my profit by $10,000. I'm adding a premium onto my purchase price to pay their realtor fee.
Right. 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 Yeah. So it's not just the 15%, it's also an additional.
Well, 15 grand, right? 3%. Right. So that's the way I would negotiate it from the lister's side. You know, I would, and then if I knew that they had the cash to be able to pay it, then it would be maybe then it's just maybe I don't go 25, maybe I only go 20, or I go the 15, but I say I'm only going to cover 2% or 2.5% of it, and you pick up the rest. Follow me? And so now here's something I'm going to tell you though. There are programs now with lenders. I didn't think about this when we started this. There are now programs called LTV stacking.
Yeah, I read something about that.
Okay. So
please expand. 1 second.
Yeah, no worries.
Please expand.
Okay. So there's another way to cover the buyer's agent fee, which is through LTV stacking, which, depending on the lender, some are doing it at no cost because they don't want to lose these. They want to pick up more purchase business. So what they're doing is, let's say you're approved at 20% down,
Mm-hmm.
and same situation. You're a $500,000 purchase price. You're putting 20% down, which would be $100,000, a $400,000 loan amount, right?
Mm-hmm.
So similar to FHA, where they will finance the upfront mortgage insurance onto the loan. So your loan is calculated based off of 400,000, but your real loan, when it's finalized, is for 400 and, I don't know, 67 change. 400,000, 6,700 and change. I don't know what the exact thing pencils out to. So basically what they're doing is that mentality. So what they're saying is, we'll give you the loan for 400,000, but we're also going to lend you the extra $15,000 to pay the closing costs or the buyer's agent commission, and it's not going to affect the pricing.
Yeah, that's an incredible.
Some of them are actually doing that now, even for the broker comp on the loan side. Now, these are generally not traditional loans. They're more of hybrids. But, for those borrowers that can't, they can come up with the down payment and stuff, but they can't, it's an option for them to cover.
Right. Right.
So they call it LTV stacking. And a lot of the ones I'm seeing are saying no charge. I don't know, you're talking about such a nominal amount of being over what the LTV is, the breaking point. So, every 5 percentage points, there's usually a hit to the rate. So it starts off at as low as like 50%.
Right.
And then every 5% as you increase it up to 100, you get a hit. There's actually loans out there that'll go to 105%,
Mm-hmm.
which is another method of this, whereas they'll pay, 5% of closing costs. So that's another way that a buyer could cover that agent's fee. Now,
Got it.
on those 105 loans, there's a hit to the rate for that. So you're getting an adjustment, or you're paying a cost to get that privilege of getting to 105.
Right.
But sorry about that. My phone's going off the hook right now. What time is it? That's why. Everybody's getting home from work, so they're calling me. So that's probably
Popular.
another option to help cover the cost. So that would give a buyer the ability to negotiate. They set their loan up first as a stacking loan,
Right.
or a 105% LTV, or CLTV technically, because those loans are done. Okay, I need to back up and reverse and correct myself. So the 105% is not a single loan. It is a combined loan to value, which means they usually run up to 96.5% LTV, and then the lender does
On the first loan, and then they do a second loan from 96.5 to 105.
third, depending on how they structure it. So there
Got
can be
it.
a first, a second, and a third, depending on the program.
Got it.
So just to clarify and correct myself on something I just realized, not a big deal for the discussion. What we're trying to do is talk about how you cover these buyer's agent fees. So if you're a savvy buyer, you would first talk to a lender like us and say, hey, listen, I'm going to buy this house. Is there any way I can pay my buyer's agent fee and you guys through this loan? And then we would look at all the options depending on how much cash you have. So if you don't have cash, you're kind of, our fee doesn't change. So it doesn't matter to us how we structure the loan. But
Right.
if you're taking advantage of some of these programs, you may have a higher rate or some additional closing costs to keep the rate where you need it, right? Because you'd have to
Right.
buy the rate or take the hits and pay for them up front. So let's say you come to us and you say, hey, listen, I have all this cash, but I don't really want to use this. I want this as an option and I'd like to have it priced out this way. We could price it out that way. And then we could also price it out where you don't have that as an option. So you know the difference in increase in interest rate and payment and all of that, right? Then once you got that done, when you went and made your offer, it would give you more leverage, because even though you're asking them to cover it, if they say no, it's not killing your deal because you're covered, that you don't have to come out of pocket for it. But you can also keep your money out. You could also come out of pocket if you have the money, is basically where I was at. Sorry, I had a little brain seizure there.
That's all right.
So that's an option there for them. But basically what it's done is it's created a whole mess of new negotiations, and nobody likes change. If you've ever been in sales, you know that this is the biggest thing I learned years ago, which is when the comp plan change, you don't panic. You just sit back and you figure out how you exploit it to make the amount of money you want to make, right?
True.
And that's not a negative thing of exploiting it negatively. It's just you have to learn what the motivations are behind the comp plan, So if you're selling widgets, the company changes a comp plan because they want you to do something different. Like they may have instead of you having just one customer and you sell them all to one, they may have a new thing where they want you to sell to 50.
Right.
So you have to figure out how you sell to 50 instead of one, because they're looking for breadth instead of depth. So that's all. It's just a change to a comp plan, and you look at it and you go, okay, I'm going to have to do a little extra work, or there's going to be a couple extra steps in the purchase process. It's not the end of the world. It'll work itself out. And in 2 or 3 years, as the old timers leave, like us, the new young ones, it won't even, if they don't know any different, and it'll be just like, this is the way we do it. So it's just that.
Right.
That's what it really amounts to, is your friends, old school is used to doing one way, and change is change. Doesn't mean it's good or bad. It just depends on how it affects you and then how you react to it. It's the same as when you're dealing, I'm working on this loan right now, and we're on our 3rd lender with it. Not because we're not getting approved. We're not happy. My client and I are not happy with what the lenders are coming back with.
Oh, well, yeah.
They had suggested they could do the loan a certain way. Then we submitted it, and then they said, oh, well, we don't accept this kind of income. So then I take it to, I go to this other lender and I say, do you accept this kind of income? And they're like, oh yeah, we got no problem with it. And then they say, but, and they change it.
Right.
So now we're under our 3rd lender, and it just got approved. And luckily my clients, he's been a real estate investor for over 20 years, and he knows how this stuff works. He doesn't get upset. He gets as frustrated as I do with just the annoyance of people not, overselling their product, right?
Right.
And the problem is you can talk to them and cover all your bases, and they just honestly may not understand everything about their guidelines. And they're the one that needs to be the expert on their guidelines, not us. Especially when you're not talking about standard conforming, Freddie, Fannie, FHA, VA. This is in the non-QM world, where there's just a lot of different programs. It's a DSCR loan, and everybody's a private lender in that you're dealing with. You're dealing with different investors that like things and don't like things, and that's where it gets really crazy in there. But the good thing is, here's the thing I'll tell you. Right now, we'll talk about rates. So, right now, a DSCR loan for an investment property is actually below conforming. So this happens every once in a while where the markets are upside down a little bit. you can get a DSCR loan on an investment property for like 7.5, 7.75 right now.
Hmm.
And if you do the same conforming loan, the pricing is like high eights, mid eights for the same loan.
Wow.
So now what we're doing is we're flipping over to do this loan, and we're not doing conforming, which we'd normally do with him, and we're doing DSCR, and they're not explaining all of what they're doing. So the first issue was some of his properties are Section 8 housing, and the investor doesn't like properties that are based on Section 8 housing. I don't know how that's legal, but you know what? When it gets down to it, I'm not going to argue with them. I'm going to move on to another lender, right?
Right.
So I move to another lender, and the properties also have ADUs on them. And I discussed this with the rep over there, and I said, hey, I want to cover all my bases. Are you okay with ADUs? Yeah. Are you okay with it being on Section 8? Yeah. Are you going to give me all the income? Well, no, we give you like, 75% of your ADU income or something. I don't remember what the number was they were saying. I said, well, it still works with that. We still have a proper DSCR score. So I submit it in. And then it comes back from the underwriter, and the underwriter says, no, we don't give, we won't let you have the income on the ADU. Oh, well, then the deal's dead, right? Or what we did was we had to take a cut on the loan. Instead of being 75% loan to value, we dropped down to 65. So we took a 10% LTV cut, and the rate.
Hmm.
So,
Interesting.
so then the client and I had a conversation, and it was basically, what do you want to do? Do you want to go with 65, or do we want to go somewhere else? And see, there's other people that say they'll go to 75 and 80. Do you want to go see if one of those will take it? And I'll ramble through everything I've got again, and we'll see if we can. And he's like, yeah, it's worth it. I want the extra 10% because he's trying to do it's for business purposes. So he's trying to do an investment, and the ROI is huge on this. So he wants that extra, that extra money if he can get it, and he wants to take the max out of that property that he possibly can. Because it's hard to go back afterwards. If you do a loan at 65 and then you turn around and you try to go to, let's say 3 months later, you want to go to 75 with another lender. Now you're having double the closing costs. We don't want that, right?
Right.
It cuts into his cash out, which isn't good for him. So I said, okay, I don't mind. I'll do it. I just want to know what you want to do. I mean, it's just me. It's really easy for me to submit it to another lender. I just drag and drop and send it. Takes me, 15, 20 minutes. So we've done that, and the thing just came out and we're approved, and I looked through the conditions, and it looks good. We'll see when we talk to the underwriter, because I haven't gotten a chance to talk to the underwriter yet, but I have a couple conditions in there I want to talk about, but nothing major that's really concerning. It's more of, can I get away without doing something?
Right.
Like he's getting cash out, and they're asking for him to prove reserves of 30,000. It's like, I'm getting 300,000 plus out in cash, and you're asking me to prove that he has $29,000 cash sitting in his bank account. Now I know he has the money. I just don't want to disclose it.
Right.
That's the thing. And generally they will waive that, but you have to have the discussion with them. They'll
Right.
think, oh yeah, I didn't even think about it. I didn't think that he's getting 300 grand out, or 10 times the amount of reserves he's required to have.
It's true.
So, how are we
The
doing?
human factor sets in. Human factor sets in on all levels. Underwriters. I think we covered.
The commission thing.
Yeah, I think we covered it
And the great
fairly
thing
well. So
yeah, sorry, I didn't mean to step over you there. I think the great thing was it reminded me of the LTV stacking. We were
yeah,
which is on our side. We can help with that. That's a that's a service we can help, and we should be pitching maybe to realtors to let them know, especially buyer's agents, that
Right.
this is an option. Because I know on the contract, it states buyer does not have the ability to pay, which is a negative for a lot of people. I mean, you have to look at the real estate agent's point of view. We run in this business, we're not allowed to charge upfront fees. And so if you're a real estate agent and you're driving around all over the place, spending gasoline and your whole day showing someone at the last second, property,
Right.
and they can't afford to pay you, which may kill the deal if your only option is the seller to agree to pay you, it puts you at a disadvantage. It also puts you at a disadvantage because the seller could try to renegotiate with you. And I don't know if that's ethical. They should just look at the deal up and down and say, I'm either going to do it or not. It seems kind of unethical to renegotiate a deal that somebody else has agreed to. I think it should be either pay the agent's commission or don't pay the agent's commission. But I also
Right.
see where there's going to be some hurt feelings involved with different agents, listing agents that are getting paid less than the buyer's agent because they negotiated something different. If you're a listing agent and you negotiated 2 or 2.5 or 2 3/4, and this buyer's agent comes in and all he did supposedly, it's always all he did was show up with his client and make an offer. He didn't have to do anything. Well,
Yeah.
he probably showed him 20 or 30 other houses, and maybe
Exactly.
10 or 12. I had a friend who asked me to represent them to buy a house 2 years ago, and we probably looked at 75 homes and made 20 offers. This was when things were going crazy because
Oh, wow.
people were offering over listing price right off the
Right.
bat. We would
Right.
go to a house, the house would come on the market, we would drive over to look at it 20 minutes after it was on the market, and there was a line out the door to go inside to look at the place, and
Right.
a million, she was looking at $1.5 million homes, and people were offering $500,000, $600,000 over listing.
Wow.
So we wrote a lot of offers, and she's like, I am not paying over. And I'm like, I don't blame you. That's my philosophy. If the market's that crazy and out of whack, I wouldn't want to buy. I'm going to wait till it settles down, because sooner or later it's going to settle down. And then reality is going to set in, and then you can make legitimate offers, and it's not a hysteria. Don't get caught up in the hysteria. So she was fine with that, but we looked at a ton of places. And then what ended up happening is one day she called me and says, hey, Rob, you know what? I'm sorry, but I think I'm going to move out of the state. And she moved to the Midwest, and instead of spending, $1.5 million on nothing,
Right. Here it's nothing. Right.
Right. She bought a huge house on a huge lot, like on a half-acre lot, with fruit trees and all sorts of stuff, and a basement, and a 5-bedroom house in the Midwest for $500,000.
Wow.
And it also was a benefit for her because it put her in the Midwest, which then increased her ability for her job to be able to be more able to go to the East Coast. So she was always flying to the East Coast for 3 or 4 days a week. So now instead of an all-day flight, it's a 2-hour flight to get to Washington, D.C. or
Right.
New York or Chicago.
Right.
And same with going to California. It's only a couple hours to fly there. So it really helped her and improved her ability to take on more clients. I don't want to get into what she does, but she's well sought after in the tech space. So it was just an all around thing. And I was like, yeah, that's great. I don't blame you. And now, I had already shelled out probably 2 grand in gasoline because at that time, of course, when the housing market was going crazy, gas prices were at the $5-6 range here in California.
Right.
So every day
Right.
we were driving, I was dropping $150 a day.
Jeez.
So
Things add up, man. People don't realize how much time.
covering of that.
Exactly. People don't realize how much time real estate and mortgage professionals invest. When you're going to show, in your case, 75 homes, that's easily, just in drive time, it could be 30 minutes to an hour here in LA, Orange County, wherever it is, just in drive time. Not to mention, let's go look at the house. And that turns into easily an hour. Maybe it's sooner if it's not a desirable house when you get there. But if it's something you're really considering, you're looking at the roof, you're going into crawl spaces, you're going here, you're wanting to think through this, connect the dots, see if it's going to be something you really want to put an offer on. And then if you do want to submit 25 offers, for crying out loud, I mean, how long does it take to write all those offers and think through all the different dynamics of the deal? You're 75 hours,
You have to import all the information on the property.
right,
You have to, there's certain things that are canned, right?
right,
Then there's the add-ons for that specific property. You have to list. You have to do so every time you have to put in a different property, a different listing agent, different listing broker, the company name, and
right,
then you have to put in not just the property, address, but it's all the information on the property you have to import into it, and then you have to write it up based off of the dollar amount your offer, and then changes based off of that property what you're asking for. So a lot
yeah,
of homes, it's not just I'm buying the home, it's I want, on this home I liked that chandelier that was in there, so you have to make sure that you mention that chandelier so on closing time it's not missing.
right,
Or if there's certain furniture, maybe there was a beautiful dining room table set or something like that, and that's something that's listed, maybe so a lot of times on these listing agents, these listing MLS listings, it'll talk about all the things that the seller is possibly willing to sell with the house,
right,
can be negotiated in. So then when you get into all that fuzzy stuff, now you're writing up all this extra stuff. So yeah, it's a good, you figure probably an hour to write a deal, and then it's chasing everybody down to make sure that they sign it or they know they got it.
that's right,
And then just to make an appointment now, it's not like the old days, just so you haven't done it in a while, but you don't just show up to a house and open the door and go in. Most homes are by appointment only now. So you still use your lockbox. It's an electronic lockbox.
yep,
Majority of the time, because that's what's required if you are a member of NMLS, even though people violate it all the time. But now that software has been updated to where you request the time and then you're approved for that time, and then you have to show up, and at that time then your key will work to let you in.
interesting,
So it's not as simple as go direct and don't bother me like the old age. In the old days, agents would put in the notes, go direct, don't call me. Now it's call me to schedule or file a request to schedule an appointment, and you do it electronically. So it just depends on who you're dealing with. So that
right,
time too, you're doing that on every property that you want to see. And then a lot of time, and you're trying to, when you're trying to see properties, you're trying to set up a drive schedule of the homes so that
right,
you don't have to do, you're trying to say, okay, we're going to see this one first, then this one, this one, this one. So you're not doing a bunch of back and forth driving in a city, or driving 40 minutes here and then 20 minutes
right,
here and an hour back over here. And then it's also, you got to take time, you got to calculate in traffic, because
exactly,
it's not just, it's 5 miles away. Well, where is that 5 miles you're driving?
right. Could become 30, 45 minutes if you're in LA
Yeah, I got to figure out something.
very quickly.
Cameras. I'm not like you. I barely have I'm like Kilroy. Look, see, if you, boy, that's a reference, and I'm not even a boomer. Um, actually, that's not even a boomer reference. That is a, what do they call it? The Great Generation reference. That's a World War II reference. So yeah, I think we covered everything. Unless you want to touch on
No.
anything else, or how are we doing on time? I don't even know where
We're an hour in, so 60 minutes. So
okay.
I think that's good for today.
Yeah, yeah. It was a pleasure. So I think we probably should be saying this at the beginning, but like, subscribe, make a negative comment,
Or a positive comment.
or a positive. If you feel like you really have to say something positive, we just want to comment if we can.
Yeah.
And, we'd love a like. We're not trying to make money on this, but if I understand the algorithms, the more people that do all that stuff, the more people get to see it. And what we're hoping for is people will contact us to do business. So
yeah, that's our long end. Was it long game goal?
yeah.
So
yeah. And also to give a little bit of our view of how to do things. We're not the only ones out there, but
right. But we between both of us, we're very experienced in solving financial situations. If you're wanting to buy a house as a first-time buyer or start your venture as an investor and owning multi-units or rental units. So yeah, not that we know everything, I don't, but we're willing to figure it out.
Oh, we do. I think next time we should probably either cover, we can cover the difference in putting different amounts down, or we can cover what it takes to buy an investment, be a first-time investment buyer. Like, what are your options? Because a lot of people don't even realize. I mean, I know when I was younger, I didn't know that I could have, bought a bunch of investment property. And generally, what I see is people that are heavy into the buying investment property, someone in their family was doing it, an uncle or their parents, and they've kind of been taught through their life. So if you're somebody that's thought about, hey, I'd love to get into owning property for investment purposes, we can also talk about what the path is for that and how you go about it and all the documents involved.
Perfect.
How you qualify. So we can do those two things. One is, when I say determining the difference between putting 20% down or less, how much should you put down on a house? There's a lot of people that have different theories on that. And we can go through all those theories because you'll run into some people that say, oh, you always have to put 20% down. You don't want to pay MI. And then you have some that'll say, just get in. And then you'll have others like me that I'll do the numbers crunch and I'll say, it actually is better off if you go this route. Even if you have the money, it might be better off to keep the money in your pocket. It's like,
That's
I
right.
can pay this. So I'll circle back and then we'll finish. I can pay my broker's agent the commission out of the cash I have, or I can get the seller to pay it, and I can pay more for the house and more for the loan, and over time I'll pay off my broker's commission. But I'd rather have this cash here that I can do it. Now on a small house that's only 500,000, that may not pencil out. But if you're talking about a $3 million house where you're talking now, $90,000 worth of commission or $70,000 worth of commission or whatever it figures out to be, depending on how you've negotiated it, it might be worth it to keep that large amount of money in your bank account earning interest, especially if you don't want to liquidate something. If it's not cash, maybe it's in stocks or bonds and you're going to have a penalty for early withdrawal, or you're going to have to pay capital gains tax on it, it may make sense to say, no, I want, this is the reason, and this is why you would explain it. This is one way you could try to sell it to the seller is, hey, I don't really need you to pay it, but it's beneficial for me, so I'm willing to do this with you. If you
Right.
want me to buy the house, I'm a slam dunk on buying this thing. I'm pre-qualified. I have plenty of money to do it, but I'd rather keep this money in my pocket. So
Right.
let's raise it up. Let's raise the purchase price up, or I'm making it contingent upon this. If you want me to pay this price, if not, I'm going to lower my offer, 3%.
Right.
All right.
All right.
I've had enough of listening to myself ramble.
Thanks, Rambler. Appreciate you, Robert Duffy and Ricardo Salazar. Thanks for tuning in, everyone. We look forward to hearing from you. Comment, like, subscribe, and we'll see you on the next stream.
All righty. Thank you.